It was a strong day on Wall Street with the S&P 500 closing higher by 0.7%, and we did see that 73% of the components within the S&P 500 closed in the green. There were a handful of kind of older school dividend aristocrat types of companies that sat out today's rally, but it did have more of a risk-on type of a feel with many of the industrials and many of the discretionary stocks and even the communication stocks getting into the mix to the upside. So we'll take a look at all of that and see what it means for our postures moving forward. We'll also do a little bit of macro analysis with our asset class 12 grid and a little bit of sector analysis as well. And then we'll get into a trade application example where I wanted to balance out many of my bullish deltas I have in the portfolio right now with a bear call spread on a stock that woefully underperformed within the technology sector here today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 10th, 2023. First of all, for those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and you'll find an email distribution list. If you're not signed up for that already, make sure you're doing so. That way you can be notified whenever we post these videos. You'll also find at the bottom of those emails which stocks are giving you overbought or oversold cluster signals within the S&P 500 on those days. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as usual, I've got the S&P 500 heat map pulled up here in front of us to give us a lay of the land here today. And it was a pretty impressive showing by the bulls. So far, so good in 2023. You've probably been hearing a lot of the different statistics talking about how, things start off the year oftentimes dictates how the entire year's trading will go. So far, so good on that count, as we have seen more bullishness this calendar year than bearishness. So things can change in a hurry naturally, and we're still early in, but at least it's not a continued bloodbath like we saw so often in 2022. As you can see, the vast majority of stocks were higher here today. The market wasn't up quite 1%, but it was up there in that general vicinity, up like 0.7%. So not a surprise to see as much green as we do in front of us here. Of course, the larger squares and rectangles tend to capture our interest. So let's go through a few of those. Apple was up 0.45% today. Microsoft was up 0.76% today. NVIDIA was up 1.8% today. Visa was up 1.14% today. Amazon was up 2.87% today. Berkshire was up 0.26% today. Alphabet up 0.45% today. Meta/Facebook was up 2.72% today. ExxonMobil was up 1.5%. Let's see, who are some of the other big ones out there? How about Home Depot was up 0.89%. So you can see that most of these gains were fairly moderate. It's not like they rocked your world with exceptional upside. Nonetheless, the consistency was at least noteworthy. Interestingly enough, today it was a day where it felt a little bit more risk on, perhaps a little bit more cyclical. I say that because as I look at the red squares out there, I do notice that a lot of the consumer staples sat today's rally out, right? We have more red squares and rectangles than green ones within that particular sector right there. You also see plenty of red over here in the utilities. You had a fair bit of red there in the industrials. UPS was down, unfortunately, today. We do have a sold put going on in one of my premium classes here at Market Scholars on that, so we'll hopefully see that kind of recover. Then again, we also have a bullish trade on something like John Deere in one of my classes as well, and that one did pretty well. So it's a little bit of a mixed bag today within the industrials area. I would also say that healthcare kind of sat out today's rally. Notice that healthcare has a lot of its bigger components in the red: United Healthcare, Johnson & Johnson, Pfizer, AbbVie, and the like. It was kind of hit and miss with tech as well. Obviously, the mega cap ones did pretty well, but there were a number of tech stocks that did sit out today's rally, including Adobe and Broadcom and Intuit, which I'll actually have a little bit more to discuss about later on in the video on that one. Another thing that caught my eye is it didn't really seem like it was the type of day where dividend aristocrats were outperforming. Many of you know I'm a big fan of that group of 65 companies that are in the S&P 500 and have raised their dividends for at least 25 years in a row or more. And last year was an absolutely phenomenal year for the dividend aristocrats. They ended up only being down on the year by about 7%. To compare that to something like the NASDAQ, which was down 33%, there's a massive crevice between those two numbers, right? It's the Grand Canyon of differences there. So there was a dramatic difference between the aristocrats and more growth-oriented areas last year. Today, we didn't really see that. Some of the things that catch my eye is Johnson & Johnson was down today. It's an aristocrat. AbbVie was down today. It's an aristocrat. Let's see, what else? How about Coca-Cola was down today? It's an aristocrat. Pepsi was down today. It's an aristocrat. Walmart was down today. It's an aristocrat. Procter & Gamble was down today. It's an aristocrat. Colgate, Kimberly, Clorox. Those are all aristocrats as well, as is Sherwin-Williams. And then Expeditors up here I see as an aristocrat as well. I might have missed a few, but the point is today seemed to be a day where it was more of a risk-on mindset once again, where your traditional big blue chip lumbering giants of industry kind of sat out today's rally on a relative basis. Now the aristocrats, I think on the whole, still closed higher. You can always check out ticker symbol NOBL, Noble, to see that performance. But I do believe that it was under the performance of the general stock market here today. So a little bit different than what was more often the case than not last year when the aristocrats were regularly outperforming. And remember, that's probably a good sign. I always say I'm willing to provide those sacrificial lambs if we need it. While much of my own long-term success is a direct result of the aristocrats, I will also be the first to admit that when we're looking for healthy bull markets, I would prefer the market to be led by stocks like Apple and Visa and some of these, higher quality businesses that are not, old school aristocrat types of companies. I should also mention real quick, because it's catching my eye right now, stop me if you've heard me before, but Tesla was down again today. Now this could actually be viewed as almost like a win for the bulls in Tesla today, because it was only down 0.77%. It seems like in recent months, when it's down, it is down bad, like, 7, 8, 9, 10%, that sort of thing. So today you can almost consider that flat, but it is still, recognizing that Tesla has not started clicking quite yet, and there's still, work to be done in order to find a rational valuation in that very hard to value business there. All right, let's go ahead and mosey along now over here to the main part of the platform, get a better sense of the breadth numbers. I've got the S&P 500 pulled up here under our visualize area on the Market Watch tab. And as you can see, 369 companies were up today in the S&P 500. That's good for about a 73% hit rate. So obviously, pretty overwhelming day for the bulls. And judging by what we just saw on the prior visual, that seems to make sense to my eye as well. I know some of you are colorblind, right? And not a whole lot I can do about that. If there was a way I could change these heat maps to something that was different than red and green, I might consider that. But I've got to do what's best for the majority of people's eyes, mine included. And with Thinkorswim, they do have some limitations in that regard on their pre-built tools like that. So my apologies for those of you that might be colorblind with red and green. I always try to do my best to kind of point at where I'm analyzing and kind of speak that through and try to verbalize what some of the return numbers are, so that way some of you who are colorblind will still be able to kind of pick up on the gist of what it is that I'm referencing in that particular moment. All right, let's go ahead and now pop on over to the main charts of the platform. And we'll get started here on chart 4B. This is the 4-grid that we use, so we can see all 4 of the main U.S. equity indices all in one fell swoop here by applying the market forecast technical indicator to them. Now, obviously, the S&P 500 is the one that gets the most press for good reason. It's probably your broadest measure of what is truly happening within the U.S. Stock market. And it was up about 0.7% here today on the nose. And that was good enough to help it retain its weekly bullish posture. So that has been interesting as well. Last week, when we were right here converting from this red background into the light green background, I had some questions in my own head as to whether it was deserved to see that switch, right? And obviously, there's hundreds of technical indicators out there, with the market forecast being one of those hundreds of indicators. And at any given time, there will be some technical indicators that would suggest bullishness and others that would suggest bearishness. So we all have to recognize nothing is 100% certain in this business. But I will say that after the last few days, it seems like the market rally is a little bit more legitimate. Now, it could fail based upon some headline coming out of the Fed tomorrow, for all I know. But the last 2 out of 3 days in particular have been quite constructive on the chart. Right over here, it was giving me the impression on the 5th that with any little piece of bad news hitting the market, we could be breaking down to multi-month lows at that point. But that very next day, we had quite the robust rally. And while we gave some of that back yesterday, we kind of once again started pressing forward here today. So this has been reasonably healthy behavior. I'm still not sure I am all bought in on the whole bullish narrative at this moment. But then again, that's kind of part of my personality, generally speaking. I'm not the type of guy that's going to say, all in, right? Go bet the farm on the markets going up or down. I just don't think in those terms. I try to think in probabilities, try to think in where we've come from, what sort of a trend we're in, what sort of valuations we're dealing with, and all that kind of stuff needs to kind of come together to formulate a thought process. And that is the same thing that happens to all of you who are listening to me as well. Right? We all have a different journey on how we got to this exact moment in time. We've all been ingesting different types of information, and we may have different takeaways. But in the end, there is no crystal ball out there. Unfortunately, we try to do our best with the information we do have, and we hope that we make more good decisions than bad decisions as time goes on. So we shall see where this takes us. We have a little bit of a conflict here at the moment. That conflict is, you can see there is a legitimate bounce up and off of that horizontal support area right there, but it is currently being challenged at that diagonal resistance area known as the 30-day moving average in this chart's particular case. So you have both good and bad that are present on the chart right now. Notice that the moving average color of the S&P 500 is yellow here today, as opposed to yesterday being red. What that is signifying in today's case is, although it's hard to see with the naked eye, we did close just slightly above the falling 30-day moving average today on the S&P 500. Sometimes if I right-click and zoom in only on one chart, it can help you see that a little bit better. Yeah, and you can just barely make it out here. It's not, you're still going to have to squint, especially if you're watching this on an iPhone or something like that. But if you have a big screen TV right now that you're watching this on, you can probably see that the top corner of that candle on the S&P 500 has made its way just a hair above that moving average. Yesterday, we were well above it, as you can see with this long upper shadow in that case, but we sold off for much of the second half of the day and closed below it. So although we breached it on an intraday basis, we couldn't close above it in that particular case. Today, we didn't have as erratic of trading as we did yesterday. It was a little bit more calm type of a day, but because it was so persistent with bullishness to the upside, and we closed effectively at the highs of the day, it did allow us to close above that moving average now. So for those of you that are newer to looking at our charts, you might be wondering, well, what does it take to get that moving average to turn green the way it was back here? And what we'll need in that case is for the moving average to now start being pulled up by the price action, right? And that is oftentimes a process. It's not something that just happens overnight with a like a light switch type of a thing. So we'll see if we can get there. It's going to require a little bit of an effort out of the bulls in order to have that persistence for a longer period of time. But at least the hope is alive, right? And there were many times last year where it just seemed like there was no hope whatsoever in the system, and it was just selling, selling, selling. At least now there's a little bit of hope present, and we'll keep our eye on it on a day-by-day basis. obviously looking for opportunities, but we still remain in a more challenging time period because all of those moving averages are still moving to the downside. It's just that we're starting to get more constructive price activity that are starting to pop above those moving averages, and eventually, if they are resilient enough, those moving averages can start bending higher. So let's keep our eye on that possibility. So as you can see down below on the S&P 500, that green intermediate line has emerged out of that lower reversal zone and is now heading back towards the indicator's midpoint, but it's meeting a little bit of a resistance point on the chart there as well. 4,100 obviously was the highest level we got to here in the last couple of months on the S&P 500. A big round number. I remember doing the market outlook video that day and how interesting it was that it basically went right up to that number, kissed it, and then went right back down. So it would be a major win for the bulls if they could garner up enough enthusiasm in this market to breach that 4,100 level once again. That, I would say, is a pretty important level, at least psychologically, for the market at large. So is that a possibility? Absolutely. We're about to embark upon earnings season here a little bit later, and if the market receives those earnings quite well, that could be the excuse or the catalyst to send the markets higher. Then again, that could also be the catalyst to the downside if the economy has weakened so tremendously that earnings are basically missing Wall Street estimates and different things like that as well. Remember, another wild card in this whole conversation is what the Fed prefers. All right, the Fed's job is to squash inflation. If the stock market's breaking out above 4,100, you'd have to believe that that is not necessarily putting a smile on Jerome Powell's face. And so he knows that his job would be harder to do if that were to occur. Now, I don't know how much influence he'll have over the markets when it's said and done, but a lot of people that are wiser than me have said throughout time that you better be careful if you're fighting the Fed because they are much more powerful than the average Joe that's trading their individual accounts on a Thinkorswim platform like many of us are. Let's take a look here at the Dow Jones Industrial Average. It was up 0.56% here today, so a decent day for it, but not nearly as robust as what we saw across the rest of the stock market or the indices that are out there. And for those of you that have been with me long enough, you should know that that is not a surprise. That is the way that it traditionally works. Big moves up or big moves down are usually led by more speculative securities, and therefore on a day where we had a reasonably big day up for a lot of stocks, the Dow Jones kind of sat in the back seat with its Procter & Gamble's and its Walmarts and some of these others that really don't have a lot of growthy elements left in them that many participants within the market would prefer. So Dow didn't have a bad day, it just had an underperforming day. But similar to the S&P 500, it is above its rising 30-day moving average. So again, notice that moving average turned to yellow in that case. Let's move our attention directly below the Dow now and talk about the Russell 2000 down below here in the lower right-hand area. And there you can see, similar to the S&P 500 and the Dow, we now have a yellow moving average on the Russell 2000 as well. In other words, price closed above that moving average, basically for the first time since going all the way back here to the first week of December. And similar to what we saw in the S&P 500 and really for the Dow, we closed maybe not exactly at the tippy top high of the day, but we closed very close to the high of the day across all three of those particular indices. Now, this one specifically has been rather impressive to me because a week ago, I would have said that the Russell 2000 was more on the lagging side of the equation. Fast forward to where we're at right now, this was a massive rally on, I guess it would have been Friday, and this was a massive rally today, right? The Russell 2000 was up 1.49% today. That beat all of these other indices. So 2 of the last 3 days have been awesome for the Russell 2000, and it's amazing what a quick little pop like that can do to change your mind about the chart. Here you can see we are well above the moving average now, not just putting dipping our toe above the line or anything like that, right? Where we have to kind of squint to see, like with the S&P 500. Here, you should be able to see without zooming in on the chart, we are well above the moving average at this point on the Russell 2000. So I'd venture to guess that tomorrow morning, when we get into my factor-based swing trading class for my premium students, we will probably see the low size category probably show an improvement on the factor selector as well. So that one has impressed me, and it wasn't necessarily something I was expecting, but that's why they play the game, because if we all knew for sure what the outcome was, there would be no point of playing the game, right? And speaking of games, congratulations to all of you Georgia Bulldogs fans out there. A great game last night. And also, I will begrudgingly say congratulations to you South Dakota State Jackrabbits as well. For those of you that don't know the inside joke there, I grew up in South Dakota, and I went to the other school. I went to the University of South Dakota, the Coyotes. And so the Jackrabbits up north are our arch rivals, and they did win the FCS football championship here over the weekend against North Dakota State. So good rivalry between those two as well. So I had mixed emotions, I will admit, as being somebody who is caught up in a rivalry. You know, you don't always want to cheer for your mortal enemy. On the other hand, us South Dakotans got to stick together, because there's not a whole lot of us out there. So I always like to see South Dakotans having a little bit of success out there. So I will say something that I rarely say: congratulations to you Jackrabbits out there. So now that college football is out of the way, we're on to other things. But just like the NFL or any other sport, that's why they play the game. We can have our expectations and our assumptions and all these things in the markets, but until they actually put the rubber to the road and they start opening the bell and start trading the shares and the indices and the commodities and everything else, we all have to find out together. And sometimes our assumptions will be wrong, sometimes they will be right. So we'll keep our eye on it, but right now I will say that the small cap universe has all of the sudden started to become a little bit more impressive to me. Let's now go ahead and pop on over here to the left-hand side, the lower left-hand corner, and talk about the NASDAQ composite now. The NASDAQ is up 1.01% here today. And so a pretty good move there, right? It's the second best out of these four that we have in front of us, and that should not be a surprise. The NASDAQ comes with the more exciting names in the market much more often, and quite frankly, it's done so poorly recently that you do have that effect of what goes down the fastest can have the sharpest recoveries if market conditions change there as well. But the problem with the NASDAQ is, unlike the other three indices, the NASDAQ still has its red moving average line, because despite today's impressive move, just like it was an impressive move on Friday, it was so far out of favor by going down as much as it did. Remember, the NASDAQ during this move here a couple of weeks ago was the only major index to plot an oversold cluster signal. That's how aggressive the selling was in the NASDAQ. And so it kind of needed some sort of a reversion to the mean type of a move to blow off that steam to the downside. We're starting to witness that right now. But the problem is you do have that falling 30-day moving average that could act as a bit of a resistance there. You will notice that today's move was enough to change the background color of the chart from that pink to that green right there. So that's at least somewhat constructive. But I think the NASDAQ still, in my own eyes, remains more of a lagging area until it proves me otherwise. Whereas the Russell 2000 is actually in the process of trying to prove me otherwise, right? If you look at the Russell 2000's intermediate line, it's at 37 all of a sudden. It's still not besting the Dow Jones Industrial Average, which has been our leader for quite some time with its 39 reading, but the Russell 2000 is now a higher intermediate line than the S&P 500. And remember, last week that was not the case. So it kind of seems like the Russell 2000 in a very, very short amount of time has overtaken the S&P 500 in terms of who's next in the plucking order there at the top of the U.S. markets. Right now, I would say it's still Dow Jones Industrial Average, but they are starting to waver a little bit. And the Russell 2000 small caps are out there surging towards that area where the Dow Jones had resided for quite some time. So it's possible Russell 2000 could become a leadership group, but it would likely require that the market stay in reasonably good shape. In other words, as long as stocks continue to go up, I would say that the Russell 2000 has a better chance to overtake the Dow Jones Industrial Average. On the other hand, if the stock market starts going down again, then I would say that the Dow Jones probably stands a better chance of retaining its leadership position right there. Okay, let's take a look here at the 3 green arrows chart now. And so this will be chart 4D. And as we pull this up here, part of the reason I wanted to look at this, some of you know I don't look at this in every single presentation that I do, but I had a feeling today might be one of those days where we get some of those 3 green arrow signals. And as we pull this up, I can see that is the case. Notice that the S&P 500, the Dow Jones Industrial Average, and the Russell 2000 all have 3 green arrow signals right now. For those of you that are not familiar with that language of 3 green arrows, it comes from the prior company that David and I used to work for, TD Ameritrade / Invest Tools, and that was kind of their big approach for trend trading. And it's just kind of colorful language for looking at 3 different technical indicators all at the same time to determine whether those indicators are perceived to be more bullish by technicians or more bearish by technicians. And as we can see, those 3 arrows are represented by the 30-day moving average, the MACD histogram, and the stochastics. And so when this particular chart 4D has a 3 green arrow signal, it'll plot the background color as that light green color there. So 3 out of our 4 charts now have a 3 green arrow signal. NASDAQ is the only one where we're not seeing that quite yet, but it could be just another day or 2 away. Who knows? Do keep in mind that generally speaking, trend traders would like to see 30-day moving averages going higher, and that is the fly in the ointment in this particular case. Yes, it's true we've got 3 green arrows, but it's also true that these moving averages are still trending lower. So we've got a little bit of a conflict on our hands that only time will determine how it gets resolved. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these free presentations. Many of you are aware that it generally takes about 3 hours of our time minimum to do these free videos for all of you on YouTube. And so David and I regularly question whether they are useful to you and whether they are worth putting our time and our energy into as a result of that. So one of the ways that we can gauge whether they are useful to you is by keeping track of how often somebody is willing to click a button on Twitter. By just clicking like, it will send a message to us that you want us to continue to do these videos as often as possible. And as I always say, I've got a deal for you. If you can get me up and over 100 likes, I will be happy to do a full-length video that oftentimes goes about an hour. That provides a lot of additional commentary and analysis with the 12 grid analysis and trade application examples and all of that. On the other hand, if you kind of prefer more brevity and you want to kind of get on with your night and you only want a high-level overview of the indices themselves and you want to keep my presentation to only 15 minutes, then don't click like. Now remember, we have hundreds of people that watch these videos, so asking for 100 likes is not that big of a request. But as long as we get at least 100 likes, I'm happy to do that for you. So I'll do the same deal with you on Thursday as well. Today you got me exactly there to the button. It's always funny to me how sometimes that happens. Oftentimes it's either 100 or 101 or 102. Every so often you get some up there like 120. Sometimes it really is quite disappointing down at like 80, but it is remarkable how many times we get almost perfectly right on 100. It reminds me of that old Jerry Seinfeld commercial when he's pumping gas and he gets it right on $50 even, right? So we got right on the perfect 100 likes here today. So thank you to all of you. Remember, if one of you 100 would have decided not to click like, I would already be done with this presentation already and we would not be moving forward. So thank you to Dale and to Leo and to Pam and Brandon and Nikolai and Claire and Lucius, and we've got John and Dave and Arth and Michelle, Brian, Irvin, Curious Soul, We've got Susan and Walter and Evan and Marita, Never Back Down. So a few of you, Never Back Down and Curious Soul. I don't remember seeing you in the list before, so it's nice to have a few new viewers there as well, alongside all the rest of you that are veteran viewers as well. But anyway, can't get through all of you 100, but I always like to give a little credit where credit is due. So thank you for taking the 5 seconds out of your day to help support David and I on social media the way that many of you have committed to do day in and day out. Also, keep in mind that earlier today at Market Scholars, I taught my dividend growth investing class where we concentrated on the real estate sector. So if you're interested in evaluation of REITs and understanding things like funds from operations and how they differ from things like earnings, then that would have been part of the conversation that we had in our head-to-head matchup in our REIT category earlier today. And then David taught his directional option strategies class to his premium members earlier today as well. So feel free to check out those recordings if you got time for extra content and education on your docket later on tonight if you happen to miss those live. Also, let's have a chat here about the sector selector tool. Remember, I post this on Friday evenings, and so it is a couple of days stale at this point, but nonetheless can give us a pretty good sense of what's been going on from a sector perspective. And remember, what drives these rankings is purely based upon price. It has nothing to do with fundamentals or business models or anything like that. It is purely looking at it from a price perspective within the stock market. It is used for my momentum class, not for my fundamental classes, but for my momentum technical analysis oriented class on Monday mornings, top-down trend trading. And there we're trying to get a handle as far as where money may be flowing into and out of. Now, this particular ranking system that I use is based on an equal weighted system. It is not used on a market cap weighted system the way that the S&P 500 is. So there can be some small nuances from time to time there, but I'm trying to figure out what is the average stock in a sector doing and what is it telling us underneath the surface on a sector-wide basis. And as you can see here, we have a new number one, and that new number one is industrials. Industrials were actually number one for one brief week back here in late November as well, but they didn't stay there long. They immediately went down the very next week. So they're back on top now, and we'll see how much activity they can control up there. I know that stocks like Caterpillar and John Deere and Boeing and a number of others have done pretty well here lately. So that's part of the reason why industrials is able to retain that strength up there. In second place, we've got consumer discretionary. And this is something that I've been trying to educate you all on and instruct upon and different things like that in my classes, because I get this distinct sense that people are overlooking consumer discretionary, mostly because Tesla has basically sucked all of the air out of the room. Tesla, of course, is one of the most important consumer discretionary companies alongside Amazon, but those two by far and away are the most important within a consumer discretionary ETF that is market cap weighted like XLY. So I kind of get the sense that people are overlooking the fact that if you actually, open the kimono, so to speak, and started going through consumer discretionary stock after consumer discretionary stock and forgetting any sort of bias or discrimination that you might have against the sector because of what you think is happening with Tesla and Amazon, you might very well be quite surprised. There are a ton of retailing stocks that are in significant uptrends right now. So keep your eye on that area if you're looking for more bullish setups that are out there. Energy did topple a couple of positions here, so they're back down to the number 3 space. Remember, energy is a very violent sector. It goes up and down dramatically. It is not like the other sectors that usually kind of meander their way higher or meander their way lower. Energy can be the bee's knees for a while and then completely get the rug pulled out from underneath of it and fall flat on its face. And then you can go right back up. And so it's a wild experience when you're dealing with oil companies, because they are driven by something that is not controlled by the managers of those oil companies. They are driven by oil prices, which the managers of Exxon and Chevron and Conoco and others don't control. There are little things they can do within their business to try to improve their business, but in the end, their fortunes are tied to the price of oil, which is basically formulated in a supply-demand worldwide market. So, we'll have to keep our eye on that, but it does kind of seem like more cyclical areas that are kind of outside of commodities have done a little bit better here lately, with industrials, discretionary, and then financials kind of moving into that number 4 position here week over week as well. Remember, that's important because starting this week, later on, either Thursday or Friday or whenever it is, the big banks are going to start reporting. And that will carry through until next week as well. So financials are usually the ones that lead us in that earnings parade. And they're going into the earnings parade right now with a little bit more strength than what they had just a month or so ago from a price perspective. On the flip side of this, you can see real estate is dead last, and I had mentioned a moment ago we looked at the real estate area in my dividend growth investing class. Remember, in that class we think basically 180 degrees differently than traders think. Dividend investors are basically rewarded for their willingness to buy stocks that have fallen out of favor, because when stocks prices fall out of favor, their dividend yields become more attractive, not less. Now, of course, you don't want to use that concept willy-nilly and just assume that you're going to apply it to any old stock that's going to fall. We try to apply it to old school dividend aristocrat companies like your Cokes and your Walmarts of the world, because obviously if you buy a stock that's in free fall, there's no guarantees that it won't stop being in a free fall. If you've ever heard the expression of not catching a falling knife, that's what that's referring to. So you have to be awfully careful with that. But in general, dividend growth investors have grown more courageous, perhaps, with their willingness to buy stocks that are out of favor, because they are getting an equally appetizing reward in the form of the dividend yield itself. Whereas stocks that don't pay dividends, that go lower, there's no acceptable reward that's sitting on the other side of that. That's just a stock that finds itself in more of a free fall type of a moment. So admittedly, you do have to be more careful with that type of a mindset. But for those of you that have been in my dividend growth investing classes over time, last year was a perfect case in point as to why we do what we do. Last year, we performed quite admirably compared to most other investors and traders out there, because we were able to salvage our accounts much better than people who are out there doing other things in the market, right? And that won't always be the case. There'll be plenty of times where it's the opposite. But we're going through a more difficult period of time in the markets right now, and I think that does lend itself a little bit more so to those higher quality dividend growth types of names, all else being equal. I'd also point out that technology fell to the number 10 position this week, so that's not exactly what you want to see. I kind of think of technology as more of the growth compounders, whereas I think of industrials and consumer discretionary and financials and energy as more of the kind of cyclical feel to them. So we'd like to see technology kind of get out of its rut. Remember, Apple and Microsoft are still the two largest publicly traded companies in the United States. So in other words, they have the most influence on the S&P 500. So with technology continuing to fall, that's not a great sign for that particular perspective of the market. So ideally, you'd start to see that start turning around and heading higher on this graphic if we were to continue to see ongoing bullishness throughout 2023 like we have for the first week and a half of this year. But right now, that can be put into the more bearish side of the argument of this market right now, that tech is just not participating the way that you would want to see it participate. On the flip side of that, you can see that healthcare, consumer staples, and utilities all fell week over week. And I would say that's a good thing for the prospects of the overall market, right? Those are great dividend paying areas, so I'm not necessarily enthusiastic to see that personally, but for the health of the overall market, you would prefer to see the more cyclical areas outperforming the more defensive areas. And that did seem to happen here week over week. Whether it can continue is anybody's guess, but at least there is some evidence and some hints of that developing here in front of our eyes. All right, let's go ahead and pop back on over to the Thinkorswim platform once again, and let's do some 12 grid analysis. And so we will do chart 5A to kick us off. This is our asset class 12 grid. And a reminder, when we're looking at these charts here, with the background colors having different colors, green would represent bullish market forecast postures, and pink would represent bearish market forecast postures. So for those of you that might be colorblind, on the bottom rung we have 3 pink charts. We've got the US dollar, oil, and the 10-year U.S. Treasury yield. All the rest of the charts are green. So let's start with those that are in the red, because I think they are what has really driven performance within the markets over the past year plus. Let's start over here in the lower right-hand corner and see what's going on with Treasury yields here today. We had a nice little pop higher in Treasury yields after quite a vicious start to the year for yields, which, remember, is the opposite for bonds. So if you've bought bonds, you might be happy about that. I myself bought my very first individual bonds in my life last year, which is a little peculiar to say considering I've been in this business for 24 years. But for the longest time, I perceived bonds to be extremely overvalued, and I had very little interest in parking any capital in them. Last year, things changed in a hurry. And so early in the year, I did some inflation-adjusted bonds. And then here for the last 10 weeks in a row, I've participated in the 3-month Treasury auctions. And just today, I noticed that the 3-month Treasury yield was yielding up there like 4.7%, which is quite remarkable, considering that the longer-term bonds are only yielding 3.62% right now. So there's a little bit of a tug-of-war taking place right now in the hearts and minds of the bond investing community out there. But today was one of those days where the 10-year Treasury yield went up and bond prices themselves went down. However, because that is the opposite of what has happened for basically the first 5 days of this calendar year, from a trading perspective, the postures are maintained. So in other words, here was the start of the year. Interest rates have fallen, and therefore it makes sense that despite a one-day rally that we had today, it remains with a bearish posture according to the market forecast. And then the exact opposite is true with TLT, which tracks the long bond in the United States, and it's been mostly straight up to start this year. Today was a rare give back day, but there was enough bullishness inserted into the system, so to speak, that it was able to maintain its intermediate bullish posture for the time being. However, I would point out that with TLT, it did close below its moving average today. So you probably don't want to see that. I think it's a little bit too early to give up on it right now, but that is one thing that it caught my eye here today. Whereas with the 10-year Treasury yield, it bounced up pretty aggressively today, but it still closed below its falling 30-day moving average, just like it did the last 2 days. Whereas, so in other words, another way to think about that is that the 30-day moving average line has been red for the last 3 days here. With the kind of opposite of that, the bond prices themselves, that is not the case. Here you had a green moving average, and now we have a yellow moving average. Remember, those two things are not perfectly exactly the opposite of one another, because technically this TLT here is going to be tracking closer to the 20-year bonds, whereas the TNX is looking at your 10-year Treasury yield itself. But generally speaking, you can think of those two things as opposite from one another. Down below here in the other corner, we've got the US dollar. It was also up today, but not nearly as dramatically as U.S. Treasury yields were. It was more of a whimper higher here today. You'll see down below that despite us going up today on the US dollar, we still ended with an oversold cluster signal, right? And that oftentimes doesn't happen, right? The whole idea of oversold is that the selling is so heavy that something is getting plotted as a signal. Well, today, there wasn't really any selling. In fact, the buyers overwhelmed the sellers to a very, very small degree. Nonetheless, because the selling had been so aggressive for the 2 days prior to today, it remained with an oversold cluster signal. So, we've had a lot of those in the U.S. dollar here recently. I think part of the reason behind that is because the U.S. dollar was so wildly overinflated last year at times that this is that give back that it had as kind of a response to that. So eventually it'll start, evening itself out as opposed to looking at the pendulum swinging one direction or the other so aggressively. But right now the trend is decidedly lower for the US dollar. And remember, that is generally speaking a positive thing for the stock market itself. It's also generally perceived positive for commodities, especially commodities like gold. And gold continues to work and work and work, right? We're currently benefiting from that as we have a bullish trade on Newmont Mining going for us right now, where we did the bull put spread on Newmont Mining here, and you can see we're up about 80% on that trade so far, right? We still got to wait until it ends out there in February, so things can change in a hurry. But I do remember one of the commenters saying, you know, Newmont's interesting, but you're just too early on it, Brandon. And I thought to myself, I thought the chart looked pretty good, and so far so good. It seems like it has been consistently higher ever since we got into that trade. And many of our trades have been clicking here lately. While we're looking at this monitor tab here, you can see, looking at the PL open column, that pretty much all of these are winning trades that I've delivered to you in the Market Outlook videos here more recently. The only exception to that is Google. We're down a whopping 12 bucks on that iron condor. So that's one I've been keeping my eye on because we need it to close above 87, and it is there right now at 88.42, but we still have 10 days left to be in that trade, so it could easily go down below 87 in like a half an hour, right? That's how close it is. So I'm going to have to keep my eye on that, but otherwise, we've been hitting it pretty clean in these Market Outlook related trade application examples that I present to you guys for free here in this class. That is a remarkable amount of consistency in terms of profits there. And remember, it's not just all bullish trades or all bearish trades, right? Look at the delta column over here. Our negative deltas come from Apache or APA Corp and from Intuit, which I'll talk about a little bit later on here today, and then Lindy. So those are some of our bearish trades, and many of the rest are bullish trades. And I think there's this perception out there that markets haven't been very conducive to finding profits out there, right? That the markets have been hard or something along those lines, whereas what we're witnessing is quite a bit of success here. So I hope you guys can appreciate that, and I hope that that will earn the 5 seconds out of your day when I request that you click like for me there on Twitter, because the only way we can have more of these trade ideas is if you guys collectively decide that over 100 of you prefer to have more of these trade ideas. And I can't guarantee they'll be winning ones like we've had a good string of success here lately, but nonetheless, at least I can present them to you, and you guys can all determine on your own whether they are useful to you or not. So I've been pretty pleased with what we've been doing there, and gold itself has constantly been impressing me. And this is one where I've kind of been a broken record on it ever since it made this huge move here back in November. That to me was an eye-opening move because it was a trend-changing move. Remember, for most of 2022, gold was in a downtrend. And typically, if you want a trend-changing move, you need a violent adjustment. You don't just need a quick little pop higher. You don't need a whimper. You need a violent change in behavior. And that is what I felt like we received in gold back here that first week of November. And ever since then, we've now been in this persistent uptrend. Doesn't guarantee that it's going to continue. It just means that we now have the wind in our sails as opposed to the wind going against us. And so I, for one, continue to look for interesting bullish setups within the gold market. In fact, I presented one of those to our trading class here just a couple of days ago in the premium classes that I teach at Market Scholars as well. So keep your eye on that market. Remember, gold stocks are a little bit tricky because there's not a lot of individual ones that come with a lot of liquidity. There's a lot of junkier, small cap, mid cap types of gold companies out there. So that is one of the disadvantages there. But clearly, when you're looking at a chart that looks like this, you can imagine that there's a number of gold mining companies that are benefiting from a gold price that effectively is going up what feels like almost on a daily basis here. So gold has been an absolute home run here lately, and I'll reiterate what I've said many times. I expect gold to have a very good year compared to the stock market itself this year. I could be wrong about that, but that's just kind of what my gut is telling me at this moment in time. And the charts are backing up that gut feeling, by the way, as well. Moving our attention to the commodity to the right of gold, and it's not quite as enthusiastic of support. Yes, oil was up a touch today, just like gold was, but unlike gold, you can see oil is now in a downtrend and has that dark pink background color telling us that we have a strongly bearish posture in that case. So I'd be a little bit more hesitant personally within the energy patch. Now, there are obviously always exceptions exceptions to the rule. But in general, I just think it makes sense to be a little bit more cautious with some of those oil and gas names that did so well last year if the main commodity that drives them has kind of a, more of a downward feel to its chart. So I'm not sure if I'm quite impressed with oil the way that I am with gold. Right now, I think gold is the winner. Everything that we have here in front of us suggests that to be the case at any rate. You can see here that Bitcoin had a pretty good day. In fact, I didn't even notice this until just now when I'm pulling this up with you guys on the fly, but that's actually a pretty good day there for Bitcoin. It was up above 17,000 now. I remember for the longest time when we were looking at this, we would talk about how Bitcoin just couldn't get above 17,000. This is decidedly above 17,000 now. It's up there closer to 17,500. And this is a really nice 3-day rally that we've had on Bitcoin here, up and off of a rising 30-day moving average. When was the last time I've been able to say that, right? We'd have to go back 2.5 months since that was the case last. So this has been a pretty impressive 3-day period of time here for the Bitcoiners. And who knows, right? If the market can kind of get its risk-on mindset in place for a while, then Bitcoin would be a good play right within that mindset, right? It's still a little bit of a more difficult type of an experience for people who are not longer-term believers in crypto. And I tried to be open-minded enough to say that, it could be useful as a trade. It might not be useful as a trade. I'm not one of those that's going to say, no way, I'm not going to do it. And I'm not one of those that's going to rant and rave about it to the upside either. I take it for what it's worth. And I do think it is an acceptable trading vehicle at a minimum. And it's a good way to get outsized alpha if you are correct in your analysis, simply because when it moves in a hurry. Like over here, if you were shorting Bitcoin, you would have hit a home run in basically 1 week's worth of time. That could happen to the upside again as well at some point in the future if the markets continue to behave themselves the way that they have early this year. But that remains to be seen. All I can say simply is that this was a pretty nice day out of Bitcoin here today. So let's give it the benefit of the doubt and see if it can work off of some of these gains that it's shown us. In terms of these other bonds here, high yield bonds remain with a strongly bullish posture. They were down just a touch today. They remain above a rising moving average, which we cannot say for foreign bonds, and we cannot say at this moment even for long-term U.S. government bonds. So it seems like the high yield bond market is another way to measure risk appetite, and it is also telling us what the stock market is telling us right now, which is market participants are more willing to participate with riskier assets like junk bonds and Bitcoin and small cap stocks and that sort of thing, whereas many times last year they didn't have any interest in dabbling in those types of areas. Take a look up here at EEM. It's having a heck of a start to the year as well. Here's where EEM started right here that I'm circling. Here's where it's at right now. That is one impressive move there out of that group. A lot of the Chinese stocks have come to life here lately. We were talking about the stock selector tool in my Monday morning top-down trend trading class where we stack rank 1,000 different companies out there. And we were noting how 3 out of the top 10 of that 1,000 stock list were from China. They were Chinese ADRs that are available to us here in the United States. And so, don't fall asleep on China. All of a sudden, that roaring tiger is back here all of a sudden. And we shall see where it takes us. But that seems to be the leading area. You look at EEM and then you compare that over here to the S&P 500. EEM is blowing it out of the water right now, right? It's up 15% over the last 3 months, whereas the United States is only up 8.5%. So keep your eye on some of those areas that may have been forgotten about in recent years. They're coming back to life in a big way all of a sudden. A quick peek now at the sectors. So that would be chart 5C, U.S. Sector 12 grid. And as this pulls up here, we just have the two corners, the upper right corner with technology and the lower left corner with healthcare that have the pink charts. All the rest of them are the green charts. So just two bearish postures at this moment in time. And both of those bearish postures, both technology and healthcare, both have red moving averages telling us prices below those moving averages. Whereas communications has been relatively impressive to me. In fact, communications is up every single day this year. 1, 2, 3, 4, 5, 6 straight days in a row this year that they're up, and that is tacked on to the final 2 days of last year. So communications has been up 8 days in a row. Remember, this was last year's biggest loser. If there was one sector that was consistently at the bottom of the sector selector last year, it was communications. So now, we're starting to see that night follow day, some of the bearishness turning into bullishness that may be happening right before our eyes here with communications. So it's good to see that, but we'd like to see it out of technology as well. So maybe it'll start sending some of those good, vibes on over to its technology brothers and sisters. So that's one that's really kind of impressed me here recently, and it was up very, very nicely today. It was the leading sector today, up 1.51%. Whereas discretionary was the second best here today, 1.26%. As mentioned before, no surprise that the consumer staples were the worst today. They were down 0.13%. They were the only sector that was lower here today, and that makes sense given what we saw on the heat map at the beginning of my presentation here tonight. So with one of these two pink charts, one of them being technology, I wanted to try to hunt for a bearish trade idea, and I've already given that away when we talked about Intuit on the monitor tab here just a moment ago. But let's go ahead and kind of talk it through here. Let me pull up just a normal market forecast type of a chart, and let me zoom in on this and maximize it and show you kind of what I'm looking at here. Now, Intuit is not one of these that is behaving decidedly bearish to me. It is mildly bearish. And so I didn't want to get too aggressive with it, especially knowing that many of our indices are now trading above their moving averages. It's entirely possible we make a bullish move from here. And so I don't want to be too aggressive on the bearish side, but I also do like to have a little bit of balance in my portfolio. As I showed you there just a moment ago, we only have 3 bearish trades going, whereas we have way more bullish trades going in this market outlook related paper money account right now. So this is a way for me to try to balance the scales here just a little bit to do a bearish trade on this. And you can see that there is a blue line up here. That blue line represents what the break even is on the trade that I selected. What I ended up doing was selling a February bear call spread on Intuit using the strikes of 420 and 430. That is one of the downsides of this. This is an expensive stock, and therefore you oftentimes have wide differences on the strike chain as a result of that. So this one is $10 wide, and for some of you that might automatically disqualify it, right? In other words, some of you may not have account sizes that would allow for trading of these $400 stocks like we have in this particular case. What I tend to do in this presentation is I just show one contract. Some of you that have much larger size accounts, of course, you can do as many contracts as what your rules suggest. But in general, when I'm just highlighting an example, I'm just using one contract. But even one contract on a $10 wide spread can still result in perhaps more painful losses than you would prefer. So each one of you has to kind of make up your mind on your own with that. But the general idea behind this bearish trade, and for those of you that are newer to options trading, basically what I want to happen here is for this stock to stay below that blue line between now and the February expiration. Notice that this is a stock that is off cycle when it comes to its earnings, and that did have an impact on my decision to trade it here today, because there were other trades where I like the charts perhaps slightly better, but they have earnings coming up in a couple of weeks, and I just didn't want to really roll the dice on an earnings trade or anything like that. Instead, this is going to be more of an organic play because earnings are not going to interrupt the technical analysis of this between now and February. It doesn't guarantee I'm going to make money on it, but it just means that earnings itself will not be the reason I end up failing or winning on this particular trade here. But you will notice that where I have my break even up here, and I got about $2.60 for selling that $10 wide, so that's why this number up here says 422.60. Basically, I'm adding $2.60 to the sold strike of 420 to come up with that number. And you can see that right over here in the middle of December, And also back here at the end of October, it was trading up in that level. So it wouldn't be completely unheard of if it were to get back there again. But my hope is that that is basically a double top formation. And if it gets up there again, perhaps it will be presented as a triple top. And maybe the sellers will step in once again on this trade. You can see that with today's loss, it was down about 1.7% today, obviously underperforming the market that was up 0.7% today. And in doing so, the background color of this chart changed from light green to this strongly pink color here because this green line has now rolled over. You will notice that the blue line is up just a hair, although it does look like it's more sideways. Nonetheless, maybe some of you would wait until that blue line would also roll over. But for right now, at least we can get away with saying that the intermediate posture on Intuit is bearish at this moment in time. And to me, it makes sense to focus on a bearish trade like a bear call spread in order to help balance out my otherwise bullish deltas that I have in my portfolio. Okay, so that's what I had for you. If you enjoyed tonight's presentation and you like this longer form video that includes these trade application examples and 12 grid analysis, I have one simple request for you. Simply take 5 seconds out of your day and click like for me there on Twitter. Remember, it's pinned to the top of my timeline on Twitter. You can also find the link in question in the emails that we send you with the little Twitter icon at the bottom of those emails. You can also find it with the little Twitter widget directly below the video that you might be watching right now on our website. And then for those of you that watch directly on YouTube, you can find the link to the tweet in question in the description area of that YouTube video. So whatever of those ways that you prefer, feel free to do that. On the other hand, if you prefer that I keep it to 15 minutes, that's perfectly fine as well. It helps save me a lot of time. So feel free not to click like, and that would be acceptable in my eyes when it comes time for me to do the video on Thursday as well. So in the end, we'll let you guys all decide collectively. Nonetheless, whatever you decide, I do appreciate you checking out this video here tonight. I will wish you nothing but success with your trades and your investments. Goodbye for now.